Sorry, I realized. Let's start this. Okay, now hopefully now you can hear me. The microphone was unfortunately off. So this is welcome to the second installment of our webinars for, or I guess third installment for Tax 7705, International Corporate Tax. We're going to be doing a deep dive into a couple of topics. Hopefully you've had a chance to watch the videos for modules C1 and C2 on the foreign tax credit basics, which were covered in the introduction to some extent, and on deemed paid foreign tax credits. You'll get a lot more out of these webinars if you have had a chance to watch the videos first. But even if you haven't, hopefully I can make enough sense to you that you'll find it useful. First, let's start with just the basics of the foreign tax credit again. A U.S. taxpayer, whether citizen, resident, or corporation, is entitled to a credit for foreign income taxes. That credit is limited to the part of U.S. tax caused by foreign source income. What we're going to talk about tonight is a couple of things. First, the choice of a credit or deduction that a taxpayer can make every year. Second, what is a creditable tax? Third, when do we accrue that tax? And then we will get into the deemed paid credit topics. We'll run this as just one single continuous session. So we will be covering not only this module, but this module. So going back to the first one, every year a taxpayer gets to choose whether they claim a credit or take a deduction. And as I mentioned in the video, you get to change your mind more than once for the same year. All it takes is filing an amended return, and you have 10 years to change your mind. The various aspects of this are really fairly trivial and procedural, other than a coordination of carryovers. And you'll see here at the bottom my speaking notes on carryovers. If you choose a deduction in a particular year, then that year stands alone as to what you get to deduct that year. You only get to deduct the taxes paid or accrued during that particular year. However, to make sure you don't manipulate things too much, you're allowed to, we're getting feedback, so I'll mute everybody else there. Okay. Excuse me. For a year in which you choose deductions, you have to adjust your carryovers that would be going to that year and reduce the carryovers as if you had claimed a credit. So that reduces the excess of any usable credits there for that particular deduction year. Often this reduction of carryovers doesn't have very much of an effect in a year that you claim deductions. For instance, you may claim deductions in order to push you into a net operating loss. And in that case, you would not have been able to use any credits at all. So this adjusting the carryovers provision may or may not have significant effect. Let's go to our next bit. What is a creditable tax? A creditable tax is only a tax imposed on net income. Now this is a little broader than you might think, just looking at this. Let's go on down A foreign income tax, or one imposed on net income, could be imposed on gross income, not gross receipts, but gross income. For instance, a tax on a service company that is computed as some percentage of gross income would qualify as an income tax. And even if it didn't qualify as an income tax, if you were paying that instead of the country's regular income tax, then you would still be able to get a credit as a tax in lieu of an income tax under Section 903. So the combination of Sections 901 and 903 tends to make most foreign taxes that look kind of like income taxes fully creditable. The IRS has issued over 100 rulings, or I should say rulings on over 100 countries' taxes. And I believe I've got a link to them in some of the materials or on Web Campus. You don't have to make the decision of whether it's an income tax most of the time. It's usually pretty obvious, or the IRS has ruled on it. I give an example here on the slide of Switzerland, but a more recent example is Mexico. So I think I'll use Mexico instead. Mexico has an income tax, corporate income tax. It looks a lot like ours, based loosely on our 1939 code, with some modifications to it that are uniquely Mexican. In addition, Mexico has an alternative minimum tax that bears no resemblance to our AMT. Their AMT is an asset-based tax. It's computed as a small percentage rate times your total assets used in Mexico. And this asset tax clearly is not an income tax. There was a lot of debate about that when it first came out in the 90s, and the IRS finally ruled on that tax just the way several of us at Deloitte said, you know, that's the right way to rule. The asset tax ultimately becomes creditable against the Mexican income tax once your Mexican income tax goes above zero. So it works kind of like our AMT in that respect. So this Mexican asset tax becomes creditable to the extent that it reduces actual Mexican income tax. And it's treated as paid not when it reduces the Mexican income tax, but when you paid the asset tax. So you have some translation differences there, but still it becomes part of an income tax because it offsets one. So this is the sort of thing that the IRS has been called upon to rule on over the last about 30 years, twice. If something looks like an income tax, then it's probably an income tax. You can usually find out a little more certainly by looking on the IRS website to see whether they've issued a ruling. CCH and RIA both have links to lists of those rulings, so it's pretty easy to find them. One of the topics I covered in the video, very briefly, is who is the taxpayer? This becomes important when we have entities treated differently for U.S. purposes and foreign purposes, such as an entity treated as a partnership for U.S. and a corporation for Netherlands. The regulations go into this to some extent. This can also be important in other situations where you're trying to decide whether somebody is liable for the tax or whether it's somebody else's liability. And on the slide, I mentioned that the concepts here are very similar to those for the home mortgage interest deduction in deciding who is liable for that tax. We're not going to spend a lot of time in this course. You need to be aware that this who is the taxpayer is an issue. It will come up during your career, and initially it may be a difficult one for you to resolve. So I'd encourage you to reach out to others that are more knowledgeable in the area when this comes up. Bear with me a moment here. I next wanted to cover when do you accrue tax? And this isn't in the other materials, but it's something that comes up pretty regularly in practice. Some countries have an accrual system of tax, very much like ours. Some countries, on the other hand, have an assessment system. There's a year of assessment, and the tax is computed in respect of the year of assessment, or I'm sorry, the tax is computed by reference to a particular year, but is due in the year of assessment. Let's take an example. On the screen here, I've got a slide of when to accrue. Let's say we have a foreign sub that is on a June 31st fiscal year, and it's in a country where you're not sure what the rules are. They accrue the tax June 31st, 2014, and they're just miraculously prophetic in how much tax should be accrued, and they get it dead right. When do you accrue that tax for U.S. tax purposes? Do we accrue it on June 31st, 2014? Do we accrue it ratably during the year ended June 31st, 2014? Or do we accrue it when that assessment is made by the government in 2015? Again, this is a very important question. We have to look to the rules of the particular country to see what their rules say about when this tax becomes a liability. This goes back to that some of the same things that are in the concept of who is the taxpayer. Who is liable and when are they liable? We accrue a foreign tax only when it is fixed and determinable, just like we accrue anything else. But we may have been able to determine it with precision, but is the liability fixed before that assessment? Is the liability fixed before June 31st, 2014? Does it become fixed the day after? Some countries, the liability accrues ratably during the year, but you may not be able to determine it. That's the case with U.S. income tax. If we have profits in the first part of the year, and then a loss in the last half of the year, so that we have a net zero, what's our tax for the year? Well, it's zero for the whole year. So when do we accrue that income tax? Remember, the financial rules are much different than the tax rules. The financial rules say we have to come up with an effective tax rate for the year. The tax rules say we have to be visionary. We have to come up with the right answer for the whole year, before the end of the year maybe. So with this foreign difference in years, we can have a pretty big difference in when we accrue a foreign tax. And that difference can put a tax in a different U.S. tax year. So this becomes a pretty important question. And as I said, it comes up very regularly in practice. Once we've determined the foreign amount of the tax, we have to translate it to U.S. dollars. Let's see if I can get the arrow right. Well, I can't. So how do we translate it to dollars? Well, we use the average rate for the year. if we're on the accrued basis. But some things can change that. If we make a payment of that tax before that year, then we use the spot rate at the date of payment. If we make a payment after the end of the year, that's okay. We still use the average rate for the year, provided that payment is within 2 years of the end of the year in which we accrued the tax. And in the video, I have an example of a payment on October 2nd, 2015 for taxes for the year 2013. And I point out that if the tax year is the calendar year 2013, then that October 2015 payment is within 2 years of the end of the year. But if our tax year ended before October that we're making that payment for, then it's after that 2-year period. If it's within the 2-year period, we use the spot rate for the accrual year. If it's after the 2-year period, I phrased that wrong. If it's within the 2-year period, we use the average rate for the accrual year. So average rate if we pay it within 2 years. If it's more than 2 years after a year end, or any time before the beginning of the year, then we have to use the spot rate on the date of payment. Let's talk for a minute about deferred taxes. We're all accountants, we're used to financial statements, and we have deferred taxes, federal, state, local, foreign. We don't accrue deferred tax. It doesn't matter whether it's state income tax or foreign income tax. You don't accrue deferred tax for getting a deduction or a credit for U.S. federal income tax purposes. So anything that hits the current provision is accruable, and you may have to modify those accruals in the current provision to conform to U.S. tax principles. But for the most part, you can follow the current provision on the financial statements for your foreign subs if they're in U.S. GAAP. But you don't look at the total provision because that's going to include deferred. I think I beat that up enough. The next topic I wanted to dive a little deeper into is adjustments and modifications. If we claim a credit for taxes accrued, then things may change on that accrual. You know, if we're not clairvoyant and can't tell as of the end of the tax year exactly what that foreign income tax ought to be, we make our best guess at it. And we get to filing the return, and lo and behold, something changes, then that's an adjustment. If we are on the taxes paid basis, we pay a tax, later get a refund, then that's an adjustment. If we get later assessments, even if they're surprises, if we get later refunds, all of those things are adjustments that we must then apply to our foreign taxes paid or accrued for a particular year. When there's an adjustment, we're required to notify the IRS within 180 days if that adjustment has any effect on U.S. tax. Now, the regulations say you have to notify them within 180 days and don't have the if it affects U.S. tax part, but absent that, regulations become kind of silly. So in practice, it's only if it has an impact on the credit or deduction you actually claimed and got on your return. If there is tax due or a refund as a result of that adjustment, then you have to file an amended return on 1120X, 1040X, whatever. Some adjustments, though, may only change foreign taxes that we got as a result of the deemed paid credit rules that we'll be talking about in the latter half of tonight's webinar, where there is nothing but a change in the pools and it doesn't impact our net U.S. tax after credits, then we don't have to do anything except adjust the pools. Now, caution there. An adjustment to foreign tax can change your foreign tax credit limitation because of the interest expense apportionment rules under 861 that we'll discuss in a different module. So keep this adjustments to tax thing in mind as we're going along. You'll find that you have to do an adjustment a lot more than you might otherwise think. One additional item to mention, if there is additional U.S. tax due, you have to pay the IRS interest on that additional tax. There's no penalty because it's something that's unforeseeable. There's no late payment penalty. It's just additional interest if you have to pay them additional money. If you're under examination, and most large companies are all the time, then the way you go about notifying the IRS and filing the amended return is you notify the IRS team of the adjustments, not every single one individually, but typically every 3 to 6 months you give them a notice of what has changed, and then they roll that into their list of adjustments that they will be making for the return. So that gets us to the end of this first module, and I'm going to keep the recording running here for just a moment as I take a swig of my iced tea, and we'll continue within a few seconds on the second module, deemed paid foreign tax credits. Okay, and we're back. The corporate shareholders of foreign corporations. Oh, I have to catch up here. Bear with me. Corporate shareholders of foreign corporations get a credit for foreign income taxes deemed paid. Those are the taxes paid by their foreign or domestic non-consolidated subsidiaries in which they own 10% or more. And those deemed paid credits are usable or available when the subsidiary pays a dividend to the U.S. company. There is a 6-tier limit on this deemed paid credit. And let's kind of walk through this verbally a little more than I did in the video. The U.S. parent company is the one that is able to get this deemed paid credit. It's available for taxes paid by first, second, or third tier subsidiary as long as these ownership tests are met of direct 10% and ultimately 5% indirect ownership. It's available for those first, second, and third tier subsidiaries, whether they're CFCs or not. So for instance, my U.S. parent company could own 10% of a first-tier subsidiary that's otherwise owned by foreign people, that owns a 100% second-tier and 100% third-tier subsidiary. And if that third-tier subsidiary pays foreign income taxes, then ultimately, when the U.S. parent recognizes a dividend or subpart F income up the chain, the parent will get a credit for their portion of those foreign income taxes paid by the lower tier subsidiary. This is kind of tough stuff. The 902 regulations are among the hardest of the international regulations, which I'm sure you realize by now are kind of difficult. So there's this 6-tier limit. Now I've said down at the bottom here that et cetera to 6 tiers. For credits for taxes paid below the 3rd tier, the lower tier subsidiaries must be controlled foreign corporations. So while the 1st, 2nd, and 3rd tier subs don't need to be CFCs, the 4th, 5th, and 6th tier do, to have the credits flow up the chain with the dividends. So let's go over here and talk about something that we can do to change this a little bit. Here's our same diagram again, with the parent company owning 10% or more of the 1st tier sub that owns 10% or more of the 2nd tier, and the U.S. parent indirectly owns at least 5% of that 2nd tier. Let's say we have 7 tiers of subsidiaries down here. Way down here below the bottom, we've got too many tiers of subsidiaries. Well, we can change the number of tiers by checking the box on one of these subsidiaries to change it from a corporate subsidiary to something else. For instance, we could change, if we own 100% of this 2nd tier subsidiary, we could change it to a disregarded entity. And then that 7th tier subsidiary down below would be one for which would be eligible for credits. When you see international structures that are a result of an acquisition, often you see these deep structures. U.S. corporate structures tend to be very broad and flat. And the reason for this broad and flat is what you're looking at right here on the screen. It's this 6-tier limit. And it used to be just a 3-tier limit. So that's the historical reason for the U.S. broad and flat structures, is to make sure the U.S. parent company gets the foreign tax credit for taxes going all the way down the chain. I've seen Dutch acquisitions, or I should say acquisitions of Dutch companies, where the U.S. company acquires a Dutch company and it has 10 tiers of subsidiaries. And one of the first things you have to do in planning for that sort of an acquisition, either pre or post acquisition, is do some of these check the box things, or reshuffle things so that you don't have so many tiers and you get a credit for all of the deemed paid taxes. Let's go through a little bit about how the deemed paid credit works. I'm going to go a little bit forward. One slide. The deemed paid credit flows up with dividends. When a sub pays a dividend, a portion of the tax that they've paid goes with the dividend and goes either up the chain or up to the U.S. parent. The U.S. parent does not get a credit until the U.S. parent recognizes dividend or subpart F income coming up the chain. So here is the formula that is used to determine how much tax flows with that dividend or subpart F income. The earnings are pooled together, and separately the taxes are pooled together. And a portion of that pool of earnings flows up, and the same percentage of the pool of taxes flows up. So we have to determine what is in this pool and what gets pooled together. For post-1986 years, all of the earnings in a particular basket are pooled together. Right now we only have 2 baskets, but for a lot of years we had 9+ baskets, and each of those baskets was a separate pool. We had to track that. With 2 pools, it's a lot easier. Now, most of those additional 9+ pools from the past flow into the passive pool. So let's digress just a bit here and talk about passive and general limitation again. The 2 pools we're talking about are general limitation income and passive income. In the case of our foreign subsidiaries, it's general limitation E&P and tax, and passive E&P and tax. So we have 2 pools, just like shown in this picture from a motel. And we have to keep track of those pools separately. Things can happen to cause earnings and taxes to go from one set of pools to another set of pools. So let's back up here just a bit and talk about yet other pools. Before 1987, the rules on pools were quite different. Each year was a separate pool, and the passive basket in pre-87 years was extremely limited. It was only certain varieties of interest. That was about it. So we had effectively 1 pool for each year before 1987. And then post-86, we have 1 pool for general, 1 pool for passive. Each of these pools has an associated tax pool with it. Now, this pooling concept can cause some pretty serious problems and serious mismatches. So let's dive into that just a little bit. Well, before I go there, let's just expand the description here so you can see this. As I mentioned down here in my speaking notes, and by the way, those speaking notes are out on Web Campus, there's a separate pool for 85, a separate pool for 86, and then 1 big pool for 87 and forward. Where there is a deficit in E&P, there's nothing left in the E&P pool, so our denominator of this fraction becomes 0, and we don't get any deemed paid taxes flowing with E&P, because there's no E&P in the pool. None of the dividend is considered to come from that year. So where we have a deficit in a pool, for instance here in the 1986 pool, any taxes paid in that year are lost. Now, if it's a deficit in the post-86 pool, and we have some taxes there, then those taxes are trapped until we earn out of that deficit. So this can have some very interesting calculational effects. For example, if we have 100 of earnings over several years and pay 50 of tax, or let's say 40 of taxes on it, so our net E&P is 60, and then we have a loss of 65, all of that 40 of tax is stuck there in that post-86 pool until we earn out of it. If the next year we earn 10 of income, so that our deficit of E&P now became positive, then suddenly we have 40 in the tax pool and 5 in the E&P pool. If we pay a dividend of 5, we get 40 of tax coming with it. That can be a pretty good thing if we have enough foreign tax credit limitation to be able to use that credit. So this pooling concept and the idea that some of those pools can go negative is extremely important in planning these deemed paid credits. So now let's take that example of what happens with deficits. And we'll take the 86-87 crossover as a critical thing here. If we've got a deficit in post-86 E&P and we pay a dividend, it triggers a carryback of that dividend to prior years. Now, why, you say, would this happen that way? Well, Section 316, you remember that from your Corporate 1 class, and what's a dividend? Maybe even your individual tax class. Section 316 says a distribution is a dividend only to the extent of earnings and profits, and it's considered to be from the most recently accumulated E&P first. So in 1987, we've got a deficit in earnings, and we paid a dividend. Stupidly paid a dividend. What happens with that dividend? Well, there's no post-87 E&P to take it out of. And our pooling concept says, well, we have to take it out of something. So the first step is we carry that 21 of dividend back. And lo and behold, that 8 of tax that we paid in 1986 is permanently lost because we have no E&P left there. Similar things can happen in the post-86 world, even where we don't have any pre-87 E&P. If we have a deficit in E&P and pay a dividend from one basket, it triggers carrying that deficit to any other basket that we've got. So for instance, if we've got, and this is a very common situation, if we have positive E&P and tax in the passive basket and we pay a dividend, then that dividend first comes out of, or comes proportionately out of the passive and general baskets. It doesn't come first out of passive. It's proportionate. So if we have positive passive basket and a small general basket and we pay a dividend, we may exhaust our taxes from the general basket, which may be at a fairly high rate, and pull out only part of the taxes from the passive basket. But again, it causes just weird effects that you have to go through the computations every time to see what the effect is. Often those effects can be extremely adverse. Let's see, no, I didn't do an example. So let's go back to some more of the stuff on 902. Next key part of Section 902 is gross up. When we have a dividend that brings tax with it, what happens with that tax? Do we just get it free, get a free credit? No, it doesn't work that way. We have to gross up the dividend for the amount of tax So it's as if we were paying a dividend of the pre-tax profits and then getting a credit for the tax. You can see my example here on the slide that if J has 30 of dividend and 15 of tax paid on earnings underlying a dividend, then the total inclusion in J's income is 45. And he gets a credit of 15, or it gets a credit of 15 of against the tax on that 45, limited by the overall limitations on the foreign tax credit. Now this gross up only applies to deemed paid taxes. If J were an individual here, then 902 wouldn't apply. If J were a partnership, then 902 might or might not apply to the partners depending on their status and their ultimate ownership of the foreign subsidiary. Gross up, again, goes back to that same pooling concept. We have to track the earnings and the taxes so we can track how much tax comes with a dividend. Just like accruing foreign tax, when we pay foreign tax at a lower tier subsidiary, we have to translate those taxes to US dollars. We don't wait till we have a dividend to translate them. We translate them in the year of accrual or the year paid under those rules we discussed earlier, that 2-year rule. So we track the foreign income taxes in US dollars. We track the earnings and profits of a subsidiary in the functional currency of the subsidiary. So we may have E&P in pounds and tax in dollars, even though that tax was first paid in pounds. We have to, again, track these two pools separately. Now, what happens if we're not clairvoyant and the amount of tax that we accrue in some year changes up or down? Well, we have to adjust those pools. We talked about that adjustment procedure earlier for adjusting the foreign taxes paid with respect to what actually hits the return. Well, we also have to make adjustments to the pools. Now, the thing about adjustments to pools is often they don't have a direct impact on the amount of foreign tax paid, except through that formula that we talked about earlier. But with pools, we don't have to go back and recalculate that formula. What we have to do is simply adjust the pools. Now, this adjustment of the pools is a prospective adjustment, but we can't just adjust the pools of E&P and tax. I lost my train of thought. We can't. I'll start over. We have to adjust these pools. I remember the train of thought. If our adjustment causes one of the pools to drop below zero, to one of the pools of E&P to hit zero, to be empty, then the taxes in that pool get trapped. But there's a bigger effect. If the adjustment to the tax for that pool causes the E&P to go below zero, then obviously there's something wrong with the concept of adjusting the pool. Then we have to adjust US tax or upper tier pools. So let's do a quick example that I didn't put numbers here. I'll put them in this part of the notes. Let's say our E&P after tax, remember E&P is after tax. And we have an additional tax payment of 60. Well, the net E&P goes to deficit. But a tax payment causing a pool to go deficit after we've claimed a credit in relation to that pool? Wrong. So that means what we have to do is take the amount that causes that deficit in E&P and treat it as not an adjustment to pools, but as a payment adjustment that has to hit someplace else. Now, if this was on a first-tier subsidiary, if it was a first-tier sub that we're making this additional tax payment for, then, and first-tier sub paid a dividend out of that E&P pool, then we have to adjust a tax return. This might happen within a year, might happen 5 years later. Now, if we have to adjust a tax return for one of these adjustments to pools after the statute of limitations runs out, there's a provision that extends that statute of limitations. So let's move on from adjustments and talk about deficits in E&P a little bit more. One of the examples that will, or one of the exercises that we're going to do in relation to deficits in E&P is a rebasketizing exercise, where we have a deficit in one basket and positive E&P in another. The E&P of the E&P deficit in one basket reduces total E&P, obviously. So it effectively reduces what's available in that other basket. When we earn out of that deficit, it reverses back. We'll talk about this concept quite a bit under subpart F later, and it's the same concept that we'll talk about in subpart F for what we're talking about here, of deficits in earnings and profits. And it's on this 9.0. Okay, let's. We will do this exercise a little bit later. As kind of the conclusion for this webinar, before we get to questions, I want to talk about the first Chicago case that is now in the regulations. Let's say we have a U.S. group, and two of the subsidiaries, or two of the members of that U.S. consolidated return group, each own 7% of a foreign subsidiary, and the rest of it's owned by unrelated parties. You might think, well, 7 plus 7 is 14%. We've met the 10% direct ownership requirement, right? Wrong. The Circuit Court of Appeals in First Chicago said, no, the ownership has to be direct ownership. It says so in 902. That doesn't mean the consolidated return regulations somehow treat it as one entity for that direct ownership requirement. Each owner has to directly own 10%. Otherwise, that particular owner does not get the deemed paid credit. As I said, that has now been incorporated in the 902 regulations. So this is a pretty critical concept. At this point, I'm going to open the microphone back up to everybody. And if you have questions, ask away. Hopefully we can hear you. If you don't have a microphone on, type it into the chat window. And I hear typing away. And while we're typing, we'll have a video conference call at 7:30. That'll give us a chance to take a bathroom break and gather our wits. And we'll reconvene the video conference call where I'm hesitant to do the 902 exercise right now as I planned. So we'll mostly do Q&A, and I'm open to suggestions during that call. Anna has just asked, how often do you see companies tracking general passive baskets on the CFC level? I see it 100% of the time on companies that are not totally unsophisticated. If you don't do it, all hell breaks loose when you pay a dividend or have a Subpart F inclusion. It's just a disaster not to track E&P. Let me give you a little bit more of my history. I started my career 40 years ago with a Fortune 100 company, and then was with 2 other Fortune 100 companies for a while until 1986 took all the jobs away from Houston. And then I went into big public accounting. So my experience in big public and then later with a large local firm was a mix of mid-sized companies through giant companies. My largest client was a telephone company that was a Fortune 3 company. Yeah, that's right, 3, not 303. My smallest company over the years has been a privately held company with about 10 million of revenues. I've been exposed to things in this entire range. The small companies often fail to track E&P and taxes, and their CPAs fail to track it. Later, one of those foreign subs pays a dividend, and then they pay me extra to figure out what happened. One of my giant company clients had tracked things but done a poor job of it. And just before they went into one of the largest IPOs in history, they engaged us to do this crisis last-minute project, figuring out what the E&P of each of the subs was, what the deemed paid credits were, and where everything flowed among the companies that were going to be split up. And it had an impact on the IPO price. So we had the project from hell for 7 weeks, coming up with these numbers. And there were 17 of us on that project for 7 weeks of 70 to 80 hour weeks. And by the way, can you physically do another 10 hours? So you need to track E&P. You need to track taxes at a CFC by CFC level. E&P is not the same as book income, especially when book income is foreign financial statements with some high level, maybe you got it right, maybe you didn't, consolidating adjustments. This particular giant company had a materiality level for making adjustments at the subsidiary level of, ready for the number, $50 million. Anything less than $50 million, they didn't make an adjustment. This was in the 90s when 50 million was real money. So we had a lot of changes to their calculations. Track the E&P, track the taxes on a sub by sub basis. If you don't, you'll regret it. If you're in mid-sized public accounting firm, you'll probably regret it 2 ways. First, the client is going to balk when you tell them, well, it's going to be an extra $38,000 this year on your normally $15,000 tax return to figure out how much foreign tax credit comes with that dividend. And then they're going to complain to the audit partner, and then you've got hell to pay. So if you're not doing it for your clients, start doing it and gradually roll that fee into it. Gradually try to catch up. Hopefully that answers the question, Anna. Okay, more questions? Well, I'd hope to keep this to less than 1 hour. We're 2 minutes less at this point. Let's say that's the end of this webinar. We'll have the video conference call at 7:30. And again, these video conferences, unless I tell you otherwise, are primarily Q&A sessions, but we will have a few of them. I'll give you a heads up beforehand. We will have a few of them that you really, really, really need to attend because we'll do particular exercises. And I'll distribute those exercises before the day of. I'll have them on the web campus well before day of, and I'll give you a heads up. We'll have repeats of the video conferences. We've got a schedule on the web campus calendar. Oh, you haven't used the web campus calendar? It's under course tools. You need to look at it. We've got video conferences and webinars scheduled for Wednesday nights starting at 6:15, and then an optional for people that couldn't fit in on the video conference Saturday morning at 9:30. And hopefully I will manage to get all of the webinars taped for you. So I think with that, we'll call it quits. And those of you that want to join the video conference in about 15 minutes, see you then.